Welcome to the wealthy path, where we turn confusion into confidence and income into wealth. The stock market sounds complicated. What if I told you it's the single most powerful tool to grow your money? Even if you start small, this is your no BS, beginner-friendly full guide to the stock market. Everything I wish I knew when I started. No jargon, no hype. Just clear, simple steps to help you invest with confidence. The stock market for beginners. The complete guide. In this video, I'm going to answer the most common questions about the stock market that beginners have, such as, what is the stock market? How does it work? And how can I start investing today? So if you're new to investing or just want to brush up on your knowledge, stick around. Let's get right into it. Let's start with the very basics. What exactly is the stock market? Simply put, the stock market is a place where companies can sell shares or portions of ownership in the company to raise money. When you buy a stock, you become a partial owner in that company. There are two ways to make money in the stock market. First is through capital gains, which means you buy a stock for a certain price and then sell it for a higher price. Second is through dividends, which are profit payouts that companies make to their shareholders. Not all stocks pay dividends, but many do. It's important to note that investing in the stock market does involve risks. So the value of your investments can go down as well as up, and there's no guarantee that you'll make money. Now let's move on to why the stock market is such a great way to build wealth. On average, the stock market has returned about 7 to 10% annually since 1926, even after accounting for inflation. So that means that every $100 you invested would grow to about $107 to $110 per year. Compare that to a savings account, which typically pays less than 1% interest per year, or inflation, which erodes the purchasing power of your money. And it's clear why investing in the stock market is a better option for building wealth over time. One of the best things about investing in the stock market is that it allows your money to grow exponentially through something called compound interest. Albert Einstein even called compound interest the eighth wonder of the world. That's because it has the potential to generate massive returns over time. For example, if you invest $1,000 and earn 7% every year, your $1,000 becomes $1,070, then $1,149, then $1,234, and so on. And at the end of the first year, you'll earn $70 in interest. At the end of the second year, you'll earn $79.70. And at the end of the third year, you'll earn $89.46. This means that your earnings are increasing every year by a larger amount than the previous year, and it's a snowball effect. The longer you keep your money invested, the more your earnings will grow. So even if you don't have a lot of money to invest, just a few $100s, you can still see significant growth over time if you leave it invested long enough. Another reason why the stock market is a great way to build wealth is because time in the market matters more than timing the market. So that means it's generally better to invest consistently over time rather than trying to predict when the market will go up or down. Of course, this doesn't mean you shouldn't be aware of current events or economic conditions. It just means that you shouldn't let short-term fluctuations in the market affect your long-term strategy. If you're constantly buying and selling based on market conditions, you're more likely to make impulsive decisions and potentially lose money. With all that said, let's talk about how to start investing. We recommend taking these steps. Step 1. Open a brokerage account. There are many different platforms out there to choose from, like Robinhood, Fidelity, M1 Finance, Webull, Charles Schwab, Vanguard, and so on. Most of them offer commission-free trading on stocks and ETFs, so make sure to take advantage of that. Be sure to compare features and fees before choosing a platform that works best for you. Step 2. Fund it with any amount of money. Many people think that they need thousands of dollars to start investing, but that's not true. You can start with whatever money you have available, whether it's $10, $100, or $1,000. Every little bit counts. Just deposit the money into your brokerage account and you're ready to invest. Step 3. Invest in an index fund or ETF. An index fund is basically a basket of stocks that tracks a particular market. It's a great way to diversify your portfolio without having to pick individual stocks. Some popular index funds include the S&P 500, which tracks the 500 largest publicly traded companies in the United States, and the Dow Jones Industrial Average, which tracks 30 large, well-known companies. ETFs, or exchange-traded funds, are similar to index funds, but they're traded on the stock market like individual stocks. They also offer diversification because they contain hundreds of different stocks within one fund. Some popular ETFs include the SPDRS and P500 ETF and the eShares Core S&P 500 ETF. Another great option for beginners is to invest in blue-chip stocks. These are stocks of well-established companies with a history of strong performance and profitability. Some examples of blue-chip stocks include Apple, Microsoft, Amazon, Google, and Coca-Cola. Investing in blue-chip stocks is a great way to get started because these companies tend to be more stable and less volatile than smaller companies. Next, let's address what is an index fund. Like we mentioned earlier, an index fund is essentially a basket of stocks that tracks a particular market or sector. For example, the S&P 500 is an index fund that contains 500 of the largest companies in the United States. By investing in an index fund, you're investing in all of the stocks within that fund, which provides diversification and potentially reduces risk. Index funds are a great option for passive investors because they don't require active management. Instead, they simply track a particular index, which makes them a low-cost and efficient way to invest over the long term. Now, let's talk about some beginner mistakes to avoid. First, don't panic sell during dips in the market. Remember, short-term fluctuations in the market are normal and to be expected. Don't let your emotions get the best of you and cause you to make a big mistake that you'll regret later. Next, avoid day trading or chasing hype stocks early on. Day trading involves buying and selling stocks within a single day with the goal of making quick profits. However, it's a very risky strategy that most professional traders struggle with. Chasing hype stocks is another risky strategy that can lead to big losses. It's important to focus on long-term growth rather than trying to get rich quick. Instead, focus on investing in solid companies with a history of strong performance and a bright future ahead of them. Don't invest money you'll need soon. This is called your opportunity cost. Short-term needs include things like paying for a vacation or buying a car. Long-term needs include things like buying a home or saving for retirement. And finally, always do your research before investing. Don't just invest in something because it's popular or because you heard someone talking about it on social media. Take the time to understand a company's financials, its industry, and its future prospects before investing your money. And the final question we're going to answer is, how much should you invest? And the simple answer is, start with whatever money you can afford to invest. Whether that's $25 a week, $50 a month, or $100 a quarter. Also remember that it's better to invest small amounts consistently over time than to make large lump sum investments. If you can afford to invest $25 a week, that's $104 a month, or $416 a year. And over the course of 20 years, you could have anywhere between $64,000 to $128,000 invested, depending on the rate of return. It's important to prioritize investing over spending. That doesn't mean you should never treat yourself or enjoy your life. But it does mean that you should make a conscious effort to set aside money for investing before you spend it on other things. And finally, automate your investing. This is a game changer because it allows you to stay consistent with your investing without having to think about it too much. You can set up automatic withdrawals from your bank account to your brokerage account and then invest that money in an index fund or ETF. It's important to keep learning. The more you know about investing, the better equipped you'll be to make informed decisions and build wealth over time. You can start by reading beginner-friendly finance books like The Simple Path to Wealth by J.L. Collins or Rich Dad Poor Dad by Robert Kiyosaki. You can also follow our channel for regular updates on personal finance and investing tips. You can check out other great YouTube channels for financial education like Graham Stephan, The Financial Diet, and Andre Geek. Podcasts are another great way to learn about investing while you're on the go. Some popular finance podcasts include Planet Money, The Dave Ramsey Show, and Invested. No matter what you do, just stay patient. Building wealth takes time. Don't expect to get rich quick. Instead, focus on making small changes that you can sustain over the long term. We hope this guide has been helpful for those of you who are just starting out on your investing journey. If you enjoyed this video, please give us a thumbs up and subscribe to our channel for more content like this. Thank you for watching.